Good morning all. Good morning. I can't really tell. Then you guys have to yell back. Is it my microphone working?
Good morning.
All right, this is interactive. Good to see everyone. We in the Senate are doing hearings all day. Everything is going on at the same time. So you will see members come in and out all day today. It does not mean that they're not interested. It means that they have competing interests that they have to attend to also. However, they have designated me as a person who will stay here until this is done, and I appreciate their designation. My name is Senator James Sanders Jr. I'm the chair of banking, and we are going to have quite the hearing today. We are going to do a hearing on the disparities in New York's banking industry, banking access for consumers and small business. Now I can hear the echo. I suspect my microphone has clicked on. And we are really going to have a great many panelists, but I want to tell a story first because I think that things are best done with stories. Aesop's fable, and I'm going to move it around a little bit. An elephant was brought into a room, and 5 men were blindfolded and brought into the room and placed around the elephant in different parts. And then they were questioned about what was it that they were touching. One man touched the elephant's leg and said, "It's a tree. It's clearly a tree." Another man touched the elephant's nose and tusk, or trunk. Thank you. We'll do this one together. And said, "It's a fire hose. It's a fire hose." Another one felt a tail and said, "It's a broom," and so on and so on. They're only by taking their mask off were they able to really put all the pictures together. Today we're going to try to do similar. We're going to look at the different pieces of the puzzle, try to find out what we are really dealing with so we can figure out how to move further. I am very interested in knowing about a problem only so that I can solve a problem. I'm not interested in knowing about it just to condemn how we fell into a hole. I am far more interested in how we're going to get out of the hole. That's my own interest, and I'm joined by some really great people. To my left, of course, is Senator Borrello, who I had no small hand in getting him on this committee, and now he is the ranker, and he will speak in a moment and introduce his member. To my far left, I like that. Oh yeah. To my left, my far left is Senator Cleare Anderson. Senator, speaking of his future, of course. Well, yes, I was speaking of his future. And not too fast, though, because he's in my district. Assemblyman Cleare Anderson, who is the chair of the Assembly Subcommittee on Banking and the Underserved Community. I'm glad that I'm really smart. So you've heard me speak of what I wanted to get out of this, and I turn it over to Senator Borrello.
Thank you, Mr. Chairman. It's a pleasure to be here. Thank you for convening this hearing. Joining me on the Republican side of the aisle is Senator Jim Tedisco, a longtime member of the Senate and a former Assemblyman, and also Capital Region representative. So thank you for being here. I just wanted to take a moment to say, when you talk about disparities in banking, this is not, thank you. Is that better? Thank you. We represent vastly different districts. I come from a very rural part of New York State, but this is still a challenge for us in the rural parts of New York State. We've seen many branches close. We have communities where literally there are no banks. So despite the fact that people may think of this in terms of urban areas where there is a lack of access, this is a an issue that can be addressed across the state. So thank you for bringing this together, and hopefully we can come up with some productive discussions and identify, as you said, identify where the solutions may lie. So thank you.
Thank you, sir. Senator Tedisco, if you pleased.
Thank you, Chairman Sanders and Ranking Member Borrello, Assemblyman Anderson, for your lead with your subcommittee, and thank all of you and our speakers and those who are part of the panels today for being here. And as you know, we're elected officials, we're senators, we're assembly people, but we're representatives. And anytime I know my colleagues can get input and guidance and a real understanding of the needs of our constituents to better create a quality of life in New York State, because we have a little bit of an exodus going on, escape here. We want to keep people in New York State. In banking, it'd be an intricate part. Everything we can do, the guidance you give us, to do what we can to reform that system, which helps people because it's part of every part of their life, whether it's their education, whether it's the loans they get for their mortgages, whether it's their small businesses, their consumers. You have a big part, and we need you to feel comfortable with the products you deal with, and as consumers, we need you to feel comfortable with the banking industry, because we want to keep people in New York State, and all the policies we have to take a look at, and our leader here, Chairman Sanders, is always open to that. And so we appreciate that very much, because he takes the input from all of us and really takes it to heart, and so does our ranking member, Borrello. So thank you so much, and look forward to hearing from you on how we can better serve the consumers and the small businesses in New York State through the banking industry.
Thank you, sir. Assemblyman, would you care to make an opening statement?
Thank you so much. Oh, okay. Thank you so much, Senator, and to all of you for being here this afternoon, this morning, and I'm really grateful to hear from some of our witnesses, to talk, our panelists rather, to talk about some of the issues that we're seeing in communities that are underbanked. I understand that we're moving to a digital age, but we want to make sure that the brick and mortar remains for our older population, but also for those who receive other types of services. We do not want our communities to be lost to banking, to the predatory entities that exist to get other financial services and products. So it's really important that through today's hearing commissioned by Senator Sanders, that we really can get to the bottom of ways to expand banking. I'm proud to have partnered with the good senator to sponsor some legislation to support the BDD Banking Development District program so that more banking institutions can come to districts that are otherwise underrepresented. But we're looking forward to continuing working hand in glove with DFS and partnering wherever possible. So again, thank you, Senator Sanders, and to the ranker, thank you for being here as well.
Thank you, sir. Thank you. I take a note of privilege to say that we have been joined by the Jamaica NAACP. This is the nation's premier civil rights group, and they have been around on this issue longer than all of us at this table combined. But they're here to see a solution today. They wouldn't mind us solving the problem today if we can. I want to thank Senate Services to make sure I don't forget that, and to my friends who are trying to keep us safe back there. It's always good to have you here. To all of the staff that have come and made sure that it is possible, thank you. In October 2023, Forbes magazine did a survey of access to banking among the states in the District of Columbia. New York State had a very poor ranking of number 45. Forbes advisor used the following 5 metrics to compare the states and D.C. Banks and credit unions per capita, predatory lenders per capita, percentage of unbanked residents, change in the percentage of unbanked residents, and percentage of residents without internet access, because that's access to online banking. We are going to hear from many different people, but we should start with, of course, our main regulators. And that, of course, is the New York State Department of Financial Services, and they are the main regulator of banking in New York State. And we will hear from the Deputy Superintendent, Samantha Darch. Did I say your name correctly?
You did. Thank you very
I
much.
probably never will again. But that's all right. Once in the morning does it. Thank you kindly for being here. Would you please make your presentation?
Yes, thank you so much for having me. Chair Sanders, Ranking Member Borrello, distinguished members of the
I'm not
Senate-
sure if her mic is on.
Is it on?
Yeah, bring it a little closer.
Is that better?
Much
Yeah,
better.
that's better. Chair Sanders, Ranking Member Borrello, and all distinguished members of the Senate Banks Committee and the Assembly, thank you for inviting the Department of Financial Services to testify for the hearing examining disparities in the New York banking industry. My name is Samantha Darsh. I'm the Deputy Superintendent of the Consumer Examination Unit, or CEU, at the department. The department regulates the activities of approximately 3,000 banking, insurance, virtual currency, and other financial institutions with assets totaling more than $9 trillion. This includes over 1,200 depository and non-depository financial service providers and nearly 1,800 insurance companies. DFS provides an average of nearly $1 billion to the state and New Yorkers every year through restitution to consumers and health providers, penalties paid to the State General Fund, and DFS assessment revenue reappropriated to other state entities. The department's operating expenses are assessed upon regulated entities under Section 206 of the Financial Services Law and are not a cost to New York taxpayers. The unit that I lead, CEU, ensures that regulated institutions abide by the state's Consumer Protection, Fair Lending, and Community Reinvestment Act laws and regulations, increases consumer access to traditional banking and lending services in underserved communities through the Banking Development District, or BDD program, and evaluates regulated institutions' branching, investment, and merger applications for their performance records and community development objectives. CEU also houses the department's Student Protection Unit, which licenses and supervises student loan servicers, monitors student-related financial practices in New York, and educates and advocates for student borrowers and their families about available financial products and services. Under Superintendent Harris's leadership, DFS has expanded its focus on kitchen table issues, taking a more proactive approach to protecting consumers by implementing new laws, promulgating new regulations, issuing regulatory guidance to enhance transparency, and returning money directly to New Yorkers in the form of restitution. This expanded focus on kitchen table issues has been solidified into the department's revamped mission statement, which was unveiled in 2022. The mission now states, the New York State Department of Financial Services seeks to build an equitable, transparent, and resilient financial system that benefits individuals and supports business. Through engagement, data-driven regulation and policy, and operational excellence, the department and its employees are responsible for empowering consumers and protecting them from financial harm, ensuring the health of the entities we regulate, driving economic growth in New York through responsible innovation, and preserving the stability of the global financial system. Ensuring that all New Yorkers are able to conduct their financial lives safely and affordably and have a pathway to economic well-being is critical to the mission of DFS. In 2022, the legislature passed and the governor signed into law a bill that required DFS to conduct a study of underbanked communities and households in New York and make recommendations to improve access to financial services for them. Unbanked households are defined as those in which no member has a checking or savings account at a bank or credit union. Underbanked households are defined as those which have a checking or savings account but have conducted some of their financial service transactions through a non-bank provider. The study was delivered to the legislature last year and created a benchmark of financial services available to New Yorkers. The report reinforced what we already know about the financial system in our state, which generally mirrors national trends. Fewer New York households are unbanked or underbanked than just a few years ago. There are a few reasons for these trends. First, the increased availability of secure and affordable online and mobile bank accounts. Secondly, the COVID-19 pandemic created a unique bankable moment for households who were receiving direct payments from the government during the crisis. A wide variety of financial service providers are active in New York State, from traditional financial service institutions such as banks, credit unions, to non-bank financial service providers such as money transmitters and retail check cashers. Speaking generally, the downstate region has the highest density of bank and credit union branches, but overall, from 2017 to 2022, there was a notable decrease in the number of bank branches in the state, going from 5,122 branches in 2017 to 4,269 branches in 2022. While there was a slight uptick in credit union branches over the same period, from 1,037 to 1,056, it was not enough to cover the difference. In New York and across the nation, the underbanked rate for white and black households decreased substantially over the past decade, while remained virtually the same for Hispanic households. In 2021, there were an estimated 452,471 unbanked households in New York, which accounts for 5.9% of total households in the state. Since 2009, the unbanked rates for households in both New York and across the nation have dropped by nearly half. While this overall downward trend is an encouraging sign of improving access to financial services for New York's broader population, it masks the reality that certain demographic groups remain disproportionately unbanked. Studies show that the socio-demographic factor most strongly associated with the likelihood of being unbanked is low income. Household income is thus an important characteristic when analyzing the banking status of households, particularly in New York, which has the highest level of income inequality in the United States. New York is also one of the most racially and ethnically diverse states in the nation. Compared to the general U.S. population, New York has a higher percentage of Black, Asian, and Hispanic residents. At the same time, Black and Hispanic households in New York have higher unbanked rates than Black and Hispanic households nationwide. Under Superintendent Harris's leadership, DFS has taken significant steps to facilitate consumer access to financial services and products, including through the Banking Development District Program, New York Basic Banking Requirements, and DFS's robust supervision of all state-chartered banking institutions, including for consumer protection considerations and community support requirements. The legislature created the BDD program to encourage the establishment of banking branches where there is a need, in part to reduce the number of and underbanked New Yorkers while also fostering local economic development. Strong community support from local organizations, residents, small businesses, and elected officials is a critical piece of establishing a BDD. To date, DFS has approved 55 BDDs across the state. Superintendent Harris, during her tenure, has approved 4 banking development branches, 2 in the Bronx, 1 in Poughkeepsie, and 1 in Brooklyn. Notably, the Heritage Financial Credit Union in the city of Poughkeepsie is the first credit union to be approved through the program. Getting a consumer to open a bank account can be a powerful tool to reduce finance charges, encourage savings, and credit building. However, many consumers in low and middle income communities who have opened accounts have often found themselves taxed with fees if they overdraw their account, dip below a balance threshold, or fail to use their account regularly. It is well documented that these high and unpredictable bank account fees are among the reasons that many households remain unbanked. Superintendent Harris has tackled these punitive fees head-on. First, Superintendent Harris issued guidance to expand access to low-cost bank accounts for New Yorkers. State-regulated banks can now offer bank-on certified accounts as an alternative to the New York Basic Banking account. Affordable bank accounts like Bank On eliminate overdraft, account activation, closure, dormancy, inactivity, and low balance fees. In the 16 months following the issuance of the guidance, 23 New York chartered banking institutions have begun offering Bank On accounts, expanding the options that New Yorkers have to access safe, affordable banking services. Secondly, through the supervisory process, DFS identified several unfair or deceptive acts or practices regarding the imposition of overdraft and non-sufficient fund fees. DFS communicated these findings in guidance in 2022, making clear that the department considered these fees prohibited, including authorized positive settle negative transactions, overdraft protection fees, and representments. During consumer compliance and fair lending examinations, the department reviews bank practices with regard to these fees. The department's guidance was nation-leading, and the FDIC followed up with similar national guidance. While the guidance was an important step in addressing some problematic fee practices, the department lacked sufficiently clear legal authority to address other overdraft and NSF fees that disproportionately harm low and moderate income New Yorkers. The department is grateful to Chair Sanders, Chair Hunter on the Assembly side, and the entire legislature, Governor Hochul, for passing and signing legislation last year, which empowers the department to prevent banking organizations from arranging the order of processing transactions to maximize the fees that consumers pay, implement reasonable restrictions on overdraft and NSF practices, impose reasonable limitations on fees for return deposit items, and impose reasonable requirements on banking organizations to provide consumers with notice about the imposition of such fees. DFS is currently drafting regulations to implement the law. In addition to banks, credit unions, and savings and loan associations, New Yorkers also rely on non-bank financial service providers to manage their financial lives. Non-bank money transfer services and check cashers are utilized disproportionately by low-income households as well as households of color in New York State who may lack access to or purposefully choose not to engage with traditional financial institutions for a variety of reasons. Consumers should not be unfairly penalized for using these services, which is why Superintendent Harris adopted an updated check cashing regulation last year, implementing a new data-driven methodology for calculating fees, which takes into account the needs of consumers who use these services. Prior to the new regulation, check cashing fees had been increasing repeatedly, going back more than 15 years, including 3 increases in and around the pandemic. The amended regulation, which was recently upheld in New York Supreme Court, replaced an outdated methodology that granted annual automatic consumer price index-based fee increases to check cashers. The mortgage lending industry has also seen incredible disruption in the past decade. Since the 2008 financial crisis, non-depository lenders have dramatically increased their market share. In 2022, non-bank companies managed more than 55% of mortgages across the country, compared to just 6% in 2011. Yet these non-bank lenders were notably not required to follow New York's Community Reinvestment Act laws and regulations. Today, thanks to action by the legislature and the governor, DFS is working to implement an expansion of the state CRA regulations, which will better ensure borrowers have equal access to mortgage financing. The federal government just adopted new federal CRA regulations late last year, which apply to all federally and state chartered banks. The department is working closely with those federal regulators to implement the updated CRA here in New York. These are just a few examples of how the department is taking proactive steps to create a more equitable financial system for all New Yorkers. In the unfortunate circumstance when we find, through examination or investigation, that a company has harmed New Yorkers, we do everything in our power to make consumers whole. To that end, since the superintendent joined DFS in 2021, the department has returned more than $344.4 million to New Yorkers in restitution, separate from penalties. The department appreciates the opportunity to testify on this important topic as we work to ensure an equitable financial system that benefits all New Yorkers. Thank you for the opportunity to speak, and I look forward to your questions.
Thank you very much, Deputy Superintendent. We have been joined by Senator Brisport of Brooklyn and Senator Cleare of Harlem. Senator Brisport, if you, I'm sorry, Senator Borrello, is there a question that you want to raise? I will raise my questions after everyone. I want the committee to have their time rather than me.
Sure. First of all, thank you, Mr. Chair, and thank you, Deputy Supervisor, for being here and testifying. I think, you said a lot of different things and to talk about this. How do we address this issue? But one of the things that concerns me, that always concerned me, as the, is the impact that we have is largely on state chartered banks. Okay, you brought up in your testimony, you have a statistic that mortgage lenders, non-bank lenders, non-depository lenders, were once 6%, and they're now 55% of mortgages, and they don't have to follow the Community Investment Act. So, I guess are the problems we're seeing now in underbanked areas what is the relationship between, I guess, the impact on state chartered banks from a regulatory and legal, the laws that we pass, the regulations that we impose? Is that in part creating this disparity? Because we've lost a lot of state chartered banks over the years.
Thank you so much for that question, Senator Borrello. I will note that thanks to your action, mortgage lenders will now be subject to the CRA. We hope and plan to have that regulation online shortly. I don't want to commit to a timeline, but we're working through a lot of issues with that. But we're confident that we'll sort of level the playing field there. And that's why we've taken such a careful focus on the action on the federal level, particularly around the CRA. The new regulation was adopted in November, and that is a regulation that applies to all state and federally chartered institutions. And so we're working with folks like Mr. Witkowski to align our CRA regulations with the federal CRA regulations, but as always, keep those New York-specific issues in mind and make sure that our CRA is responsive to our needs here in New York.
All right, thank you. You brought up also in your testimony that we obviously there's a higher reliance now on online banking. There are challenges there. You have to have broadband access, which is a huge challenge in my district. There's no doubt about it. You also have to have a computer or access to one, and a secure connection, because most people don't want to show up.
You don't want to
at a
bank at the public library,
and
right?
use a public computer for their banking. So I think it's important that we keep our brick and mortars in place wherever possible. But to speak to the online banking portion of it, where do you see are the remedies to ensure that we can safely and effectively expand that and still make sure we're not creating issues for our state chartered banks?
The department is part of the state's digital equity task force, and we're working closely with our sister agencies on expanding broadband access. While we don't have sort of control over where the internet goes, we've noticed through our work that there is a real correlation between broadband access and underbankedness, and you see it sort of at the lower income band and also, as you noted, in more rural areas of the state.
I guess the last question is, it's overall. I would just speak to where do you think we are in the regulatory? Does New York State overregulate, underregulate? I mean, we never underregulate, but where do you think we fall in our ability to ensure that we are protecting consumers, but we're also ensuring that we have a thriving industry that's growing and not shrinking?
Yeah, I'm confident that the department is taking a real data-driven, rational approach to regulation. We're a prudential regulator, right? We care about the health and safety of the institutions we regulate and the consumers who utilize their services. So we're always keeping that balance in mind, and that's part of our everyday work, right? It's being transparent in our regulations. It's working with our regulated entities. It's working with communities. It's working with all of you to make sure that our laws and regulations are responsive to the needs of the whole community.
Right. Yeah, and I think that's this is New York State. There's no shortage of of consumers. There's no shortage of people that want to use the services of our banks. So, if to me the stress is not from the supply side for them. It's more about the regulatory side that may be creating these inequities across the state. So I think that we need to be cognizant of that as both as legislators, as regulators, that ultimately we are in a I guess a rich environment when it comes to opportunity, and we have to make sure we're being careful in how we regulate things, particularly when we start talking about the difference between state chartered banks and other institutions, to ensure that we're creating an environment that allows them to prosper, because there's certainly no shortage of opportunity here in New York State. Even in some of our most underserved communities, there's still opportunity. It's just a question of are we allowing that to happen. So I'll finish with that statement. So thank you very much for being here.
Thank you, Senator.
Will you forgive me, Senator Brisport? I was supposed to have had Mr. Shanti Muhammad testify before we opened it up. This new technology and doing things a new way. Um, well, well, part of my sins that I'll have to answer for. Mr. Shante Mohammed, it's good. This is, I think I can announce you as the new executive director of the Joint Center for Political Studies, one of the premier think tanks in the U.S., and certainly the premier black think tank in the U.S., and he is our new president there. It is good that you're joining us. We will do a lot of work in the future, sir. Would you care to testify?
Yes, I would. Thank you very much. And I actually start becoming president and CEO of the Joint Center for Political and Economic Studies March 11th. So I'm the incoming president, with Jessica Fulton being the interim president and longtime lead scholar at Joint Center. I first want to thank Senator James Sanders Jr., chair of the New York State Senate Bank Committee, and his staff for inviting me and for the coordination required so I could participate in this hearing. This past summer, I co-wrote the report, Still a Dream, Black Economic Inequality 60 Years After the March on Washington for Jobs and Freedom, with the Institute for Policy Studies and Sally Sim from the National Community Reinvestment Coalition. 60 years after the famed March on Washington for Jobs and Freedom, where Dr. Martin Luther King gave his landmark I Have a Dream speech, African Americans are on a path where it will still take centuries to reach economic equality with whites. Before we look at stagnating economic inequality, let me note a few key areas where African Americans have made economic progress. In 1963, Black Americans had a stunningly high poverty rate of 51%, with a white poverty rate of 15%. In January of 1964, President Lyndon Johnson declared a national war on poverty. By August 1964, the Economic Opportunity Act was passed, along with the Food Stamp Act. In 1965, the Elementary and Secondary Education Act was passed, along with the Social Security Act. By 1969, the Black poverty rate had gone down to 32%. Today, Blacks are still disproportionately in poverty, but also at historically low poverty rates. In 2022, the poverty rate for African Americans was 17% and for white Americans 9%. There's still much work to be done to eradicate poverty in the United States. Another example of progress in bridging racial inequality is in education. Black high school attainment rate has sharply increased over the past 60 years, from about 25% in 1962 to 90% in 2022. The Black-white education gap as a result has narrowed. However, there's still a substantial divide between Black college attainment and white college attainment. With the college attainment advantage for whites in 2022, 1.7 times that of Black Americans, is substantially lower than the advantage whites had in 1962, when they were 2.4 times more likely to have a college degree than Black Americans. In education, there has also been progress in bridging Black-white inequality. The final area of progress I will mention is employment. Unemployment has been at historically low rates for African Americans over the last few years. Between 1974 and 1994, Black unemployment consistently remained in the double digits, with rates twice as high as those for white Americans. From 1994 to 2017, Black unemployment rates varied between 7% and 10%, occasionally spiking to near 17% during recessions. However, since 2018, Black unemployment has reached record lows of 5% and 6%, except during the 18-month recession caused by COVID-19. In education, unemployment, and poverty, there has been gradual progress in bridging Black-white inequality, yet there has been minimal progress in bridging income and wealth inequality for African Americans. In terms of income, for every dollar of white family income, African Americans had 58 cents in 1967. In 2021, African Americans had 62 cents to the white household's dollar. With this same rate of progress, it would take Black households 513 years to reach income parity with white households. In terms of wealth, in 1962, African Americans had 12 cents for every dollar of wealth, according to analysis in the paper Wealth of Two Nations, the U.S. Racial Wealth Gap, 1860 to 2020. By 2019, African Americans had 18 cents for every dollar of wealth. Bridging that 6 cents of wealth took almost 60 years. If that were to continue, it would take 780 years for African Americans to be able to bridge that wealth divide. It is too often framed that we are not where we want to be in terms of racial equality, but we're getting there. And the point of this analysis is noting that we are not getting there. I often state that the foundation of racial inequality is racial economic inequality, and the foundation of racial economic inequality is the racial wealth divide. Today, we are not on a path toward bridging the black-white wealth divide, estimated to be a $10 trillion divide. Serious intervention is needed if we want to repair the black-white economic divide and thus black-white racial inequality. The murder of George Floyd in the spring of 2020 pushed discussions about racial equity to the center of national attention. Though sparked by murderous police brutality, the wave of protests across every major American city that summer explicitly extended beyond the critique of state-sponsored racial violence. Protesters and pundits expanded their lens to include broader structural racism across American society and throughout the U.S. economy. The resulting movement challenged all sorts of institutions to take action in support of increased racial economic equity. McKinsey estimates that about $340 billion was pledged towards racial equity between May 2020 and October 2022. The bulk of the pledges, some 93% of total commitments, came from the financial sectors, representing less than 8% of all companies analyzed. This includes the $30 billion pledge made by JP Morgan and the over $1 billion pledge by Bank of America. According to McKinsey, between May 2020 and October 2021, most pledges were dedicated to affordable housing and small business initiatives. The former is especially true for commitments made by financial institutions whose pledges mostly went to profit-making activities like lending, though these initiatives are framed as social impact programs designed to serve Black communities. Recently, the National Community Reinvestment Coalition, NCRC, released a paper I co-authored, an initial overview of banking institutions' racial economic equity commitments. This paper reviewed the pledges made by the nation's 25 largest banking institutions. The key findings of this report include, since 2020, the 25 largest banking institutions have committed to about $140 billion in home lending over 5 years, specifically targeting minority borrowers. From 2018 to 2022, there's been a substantial increase in the share of minority and low to moderate income home purchase originations. If this increase in home purchase originations continued for 20 years, Blacks, Latinos, and LMI borrowers could finally see their share of mortgage lending reflect their demographic representation, though a racial homeownership divide would remain. Since 2020, the 10 largest banking institutions made a commitment of about $28 billion in small business lending for minority-owned businesses and to businesses in low to moderate income areas over 5 years. Though the percentages of loans to Black and Hispanic borrowers increased, the absolute number of loans to all groups decreased with a dip in the home purchasing market. Corresponding with higher benchmark rates and a drawback on mortgage stimulus by the Fed, Blacks and Hispanics, along with the general housing market, saw in 2022 a decline of home purchase loans that brought their number of loans below that in 2020. This decline marks how, despite financial institutions maintaining a higher share of home purchase loans to Blacks and Hispanics, the macroeconomic environment, greatly influenced by the Fed, can be a serious obstacle to increase homeownership. It is essential to have government programs and institutions, including the Fed, work with private institutions to maintain the long-term growth in home purchase loans necessary to bridge the racial homeownership divide. America's financial industry, alongside community stakeholders and frontline organizations, has an opportunity over the next decade to advance new and innovative actions to address racial economic equality. Bold quantitative benchmarks and progress metrics that center the wealth outcomes of consumers and communities served are essential to moving the nation toward racial economic equality. Cities like Dallas are beginning to see how financial institutions are concentrating low-income apartments in underinvested areas and taking tax credits for what is often racial and economic segregation. Efforts like this are counter to the Community Reinvestment Act's mission. A strong commitment to procurement for Black small businesses is also promising, considering the low 2% of procurement Black businesses have received from banking institutions. With the CFPB's recently unveiled final rule on Section 1071 of the Dodd-Frank Act, financial institutions will soon begin reporting specific data on applications for credit for women-owned, minority-owned, and small businesses to the Bureau. Until then, lending impact assessments were limited to loan data that banking institutions decided to release independently. Though there is CRA-related data on aggregate small business lending by the largest banks, it is only reported by banks at the county level and includes no racial data, which makes implementation of Section 1071 a critical ingredient to assessing impact. As you know, New York City's Comptroller Brad Lander in December of 2023 wrote an influential report on the racial wealth gap in New York. Some of the shocking aspects of inequality found in this report were how African Americans in New York, with around $19,000 of median wealth, have about half the wealth of the total assets of African Americans nationally, around 31,000. The median wealth of whites in New York is about 280,000. Another example of racial inequality is how a white high school graduate's median wealth is about $100,000, more than 3 times the wealth of black college graduate in New York State at 32,000. Finally, the Comptroller of New York City's report notes how a college degree only increases black median wealth from 18,000 to 32,000, while for whites, a college degree increases median wealth from 100,000 to 440,000. The national nonprofit Prosperity Now reaffirms a strong racial economic divide between blacks and whites in its annual scorecard for New York. Prosperity Now's analysis notes that in the state of New York, 50% of blacks are in liquid asset poverty, 35% of blacks are underbanked, 12% are unbanked. Finally, the home ownership of whites in New York is 67%, and for blacks, 34%. The following are promising programs to address racial economic inequality. New York is already one of almost 10 states that have implemented a state CRA, with New York CRA expanding coverage of licensed mortgage lenders in New York State, as was previously mentioned. In addition to increased regulation and data collection at the state level, there is need for investing in low-wealth households to help break the cycles of asset poverty. Recently, the appraisal gap from historic redlining financial assistance program bill was passed in Maryland. This legislation identifies the appraisal gap in formerly redlined areas that is such a problem for many African-American homeowners and invest in bridging this gap. Another promising investment are baby bonds, which I'm sure will be discussed later in the day. Connecticut just launched a statewide baby bond program aimed at babies in poverty that have a disproportionate impact of blacks and Latinos. In adulthood, each of these youths will have an estimated $10,000 to $24,000 to invest in economic opportunities like higher education, business development, and home ownership. Banks also recognize that targeted programs with subsidies are needed to bridge racial wealth inequality. There needs to be more than just lending to bridge the racial wealth divide. Investment is necessary. Banking institutions are embracing special purpose credit programs, targeting low-income borrowers, focusing on addressing the racial wealth divide. Examples include Wells Fargo $5,000 credit that buyers can apply toward closing costs, or Bank of America's Community Affordable Loan Solutions, providing down payment grants and additional loan assistance. These special products help mitigate the barriers to closing costs and down payment assistance. Yet some need to address issues of high interest rates in the market and think critically about credit scores, which continue to be a significant reason for mortgage denials. Data transparency, stronger accountability measures, and substantive investment in low-wealth communities are all essential to addressing the centuries-old foundation of racial economic inequality, the racial wealth divide. Thank you for giving me this time.
Thank you for such a enlightening report. I had promised you, Senator Brisport, the proper question, and that moment is now.
Thank you, Mr. Chair, and thank you to our panelists for your testimony, Deputy, and also to you, Dedrick, for zooming in. My first question is for the Deputy, and then my second is for both. For the Deputy, I just want to give some context. Read through a report from the New York State Attorney General's office from October 2023, released a report regarding deep racial disparities in the banking sector. And I want to read a quote from the report that says these disparities are not new. They are both persistent and rooted in historic discrimination. Public policy has thus far failed to address these issues. In fact, public policy has at times created or exacerbated them. Moreover, while discrimination by individual lenders explains some of these disparities, the problems reflect systemic failures that will require structural reforms. And one of the recommendations for structural reform from the AG's report was to pass public banking legislation with the intention being that we can have publicly owned and controlled institutions rather than private profit-maximizing banks that keep giving us the same results. So I know the chair, Senator Sanders, has introduced Senate Bill S-1754, the New York Public Banking Act. It's a bill that has 31 co-sponsors in the Senate. So I guess my question is, does DFS share the assessment of the AG's office and the 32 senators who support public banking?
Thank you so much for that question, Senator. That really gets to the heart of what we do in CEU. And, you know, I'm sorry. I'm so loud normally. You know, we have a lot of tools in our toolkit at DFS to ensure that those racial disparities do not continue. The first tool we have is the one we've already discussed. It's the Community Reinvestment Act. that holds our banks to quantitative standards of lending in the communities they service. We look at their lending on mortgage to small businesses and at the services that they provide to the community. We look at those quantitatively, and then we take a deeper dive and look at them qualitatively. We don't want you to say, I invested in affordable housing that's not truly or meaningfully affordable. We dig in, we look at the rent rolls, we look at the condition of the building through the building indicator project and make sure that that is safe and affordable housing. The second tool the team has is the state and federal fair lending laws. And that in it of itself is sort of a two-part process. First, we check to make sure that the policies that the banks have on file don't contain any of that discrimination, right? The policies on their face don't discriminate and don't have policies that could sort of unintentionally do that either, right? We have a specialist who looks at all of those. And then secondly, we go and test that hypothesis. We pull the individual loan files from each of the banks we examine and do a statistical analysis to look for any racial protected class disparities. And the third tool we have is our redlining task force. Starting a couple years ago, the department has regularly been publishing reports about redlining in New York State. The first report focused on Buffalo and Syracuse, which we know have a literal historic dividing line, and the second report on Nassau and Suffolk County. And just last month, we published a report on the whole of New York State, and that's all mortgage lenders, banks and non-banks doing over 100 mortgages per year in New York State. And then we use that as sort of a guide for our future actions against those entities. So we have a lot of tools in the tool belt, and I'm happy to make sure my legislative colleagues at the department follow up about the public banking bill.
Thank you. And has DFS taken a position on public banking?
I will follow up with my legislative colleagues and make sure they get back to you about that.
Thank you. And then my second question for both of you is, this is for context, we read a report from the New Economy Project that showed that the banks holding the vast majority of New York City's deposits only provided 25 cents in home mortgage lending to communities of color for every dollar they provided to other neighborhoods. So my general question to both of you is, should institutions failing to serve New Yorkers equitably be allowed to hold New York City deposits?
I'll let Mr.
And Dedrick, I
You
believe
pass it off to me before I can pass it off to her. So I don't know legally, what the power is of preventing financial institutions that are not being equitable in its deposits. But I do think that this should be held out publicly, that they are not serving the needs that we look at financial institutions to advance, that financial institutions aren't just a for-profit company, but they do have some type of public service and public good. And as in the comments I had laid out, the way we've been going thus far will just maintain deep racial economic inequality, great racial wealth divide. Home ownership rates have really not bridged for Blacks compared to whites nationally in 60, 70 years. So I think we do have to hold our financial institutions at a higher level of accountability if we want to see a change in the near future.
And our CRA exams of our state chartered banks look at exactly those issues. Are you lending in low and moderate income communities that you serve? And those reports are made public on our website. So there's a real transparency and also a bit of an enforcement mechanism. A poor CRA score affects a bank's ability to do mergers, acquisitions, and other business activity.
Thank you.
Thank you, sir. Senator Cleare.
Senator Brisport, you got my questions. But just to expand a little bit, and I think this question is for you, sir, regarding this bullet here, the percentages of loans to Black and Hispanic borrowers has increased. The absolute number of loans to all groups decreased with a dip in the home purchasing market. And do you have this compared to how many, any data on the application rates? I know that there's an increase, right, but how does that compare to how many people applied?
Yes, I'm sure NCRC could get you that information. I mean, I think the reason there was a decrease was that the market, declined as a whole with high mortgage rates and maybe even, more expensive homes. I do think for private companies, what we should hold them accountable for is their percentage share that they're lending to Blacks and Latinos and others. So we can be clear that when a market is strong, they maintain that increase, and when the market is weak, it's hard to punish the for-profit company for following the market. Though it might speak to the need for other types of lenders to be available for when the market is not sufficient in advancing, particularly Black homeownership, and the market hasn't been sufficient for decades. And we could argue the market hasn't been sufficient to provide affordable housing in general for generations.
Right. And just to just expand on what Senator Brisport was asking, and aside from calling them out and putting them on the website, and even whether they should hold deposits or not, do you have any recommendations for bad actors? This is something that has continuously and historically happened in Black communities, and it has generational implications. In a place like Harlem, the redlining that took place years ago is still affecting and impacting Black people's ability to own and even live and get affordable housing in that community. What tools can we use to deter this behavior and to increase the investment and fairness and equity in Black communities?
Thank you so much for that question, Senator. You heard the list of what I do. This is what I care about, right? And what the superintendent cares about. And at the end of the day, we have these three strong tools in the CRA, in the fair lending laws, and in our redlining report. And we also have enforcement actions where we've seen discrimination. We go after it, and we make the institutions who do it really pay a price quite literally.
I'd like to hear more about those prices that they pay.
I'd be happy to follow up and give you
and where it
information about
goes.
that.
And just finally, I know you mentioned here kitchen table. You have a term here. I want kitchen table issues. Just describe for me what those might be.
So I think a really good example, and one I could speak to because I'm working on it directly, is our overdraft guidance. So there were several practices that we were noticing in our regular compliance examinations. Authorized positive, settle negative sounds kind of official and
For some reason,
fancy.
I'm having trouble hearing you.
Authorized positive, settle negative, it sounds sort of official, but it's basically when you swipe, you have enough money in your bank account to pay for that item, but maybe another item comes out later in the day, and so at the end of the day when they're clearing everything, you no longer have enough money to cover it, and you have no way of knowing that as a consumer, right? And you get charged with an average of a $35 fee. Similarly with representments, you have a situation where you swipe for something and it's declined, but the processor keeps pinging to try and get paid because you've walked out of the store. And you get charged for each of those representments that you have no control over, right? And it's frankly not even the bank. It's a third-party core processor who's pinging the bank. And so that's something we've tackled head on that prevents these practices that are hurting disproportionately low-income folks who could little afford an unexpected, multiples of a $35 fee.
Okay. And I'd like to, if you could, if you get back to me, another population I'm very concerned about is our senior population.
Yeah.
Who get charged banking fees, who get charged fees to just get their monthly check. And I think that's highly unfair and inequitable, especially in low-income communities. And I'd like to know what we can do. I see that y'all have addressed a number of fees. Is that one of the things that you're looking at, and how we can get better banking products for our older New Yorkers?
That's another wonderful question. So Superintendent Harris sort of tackled this issue head on. The department issued guidance that permitted the use of the Bank On product in addition to New York's basic banking account. And one of the special features of that account is an increased number of transactions without a fee, particularly for folks over 65 years old. And we took action last year to make sure our banks were promoting those accounts effectively. We now have a landing page on the department's website where you could get links to all of those low-cost accounts that go directly to sort of where the bank has it on their webpage, but we've also asked our institutions to make it more prominent on their webpage. And we're collecting this data through our regular examinations and hope to sort of compile it in the future to drive more policy.
And please share it with me so that I can let
Happily.
my community know. Thank you.
Thank you, Superintendent, Deputy Superintendent, and maybe in the future.
No,
who knows?
not looking for a promotion right now.
Well, never say never in this business. I want to thank you for being here, but I do have one or two questions for you.
Please.
And my question, first I have to give you my sense of urgency here. I see New York on as if we are on the Titanic headed to someplace that is not sustainable, and just not a good place. You're not going to have a good ending here. The figures that you have heard from Mr. Ashante Muhammad and others on yours, I'm sure you must have found them as terrifying as I did. I found them horrifying and terrifying, and we should not simply be on a Titanic saying, okay, we can make it, move the chairs here, move the chairs there. We need to turn this thing around to someplace much better, someplace sustainable. We need to be really pushing, and I find that the financial institutions are some of the main drivers of this ship, this, as I call it, a Titanic that we're on. And under those conditions, they have a special responsibility to turn towards equality of opportunity, which is the essence of the American dream, meaning that everybody starts at the same place. Where you get to is up to how hard you work and, other factors in there. Equality of opportunity, which I would argue, do not have based on the information that has been given. Here's a rhetorical question. In fact, let me not do it as a question. I'm not trying to embarrass. Can I encourage the DFS to come up with some out-of-the-box, hard-hitting stuff that will change the way we are going? What you are proposing is worthy, but I don't believe it will work if you were dealing with not a crisis, then these would be good things. But in a crisis, you have to act in that. For example, our business development districts, sadly, are not working. They're not working. They're not achieving what we wanted them to do. We may hear later that some banks have come to me and said there's simply not enough money in it to make it worthy for the banks. If that's the case, you guys need to come to us and say, hey, put some more money in. If it's a question of legislation, you need to come to us and say, put some more. You've got to tell me of real hard-hitting things that will change where we're going. Our direction has a horrible ending, and New York deserves better. That is my rhetorical, and I'm not trying to put you in any spot, but please take back to the superintendent that there's a frustration on the ground that's building up, that we need to have real hard-hitting stuff. I thank you for that. I'll give you a chance to respond if you wish, and then I have a quick question for...
I would just say that the superintendent is committed to working closely with you and with all our stakeholders to make sure that our financial system is equitable, affordable, and working for all New Yorkers. We We look to you for a lot of leadership. We're so grateful to be nation leading. I know my co-panelists spoke about the CFPB's 1071 rule, but we have that right here in New York with the minority and women-owned business data collection requirement that we just implemented last year. We're getting our first, literally, like as we speak, our first exam data is coming in on those loans that we started collecting in August. So we're really grateful for your leadership, and we do look forward to working with you on those bold, out-of-the-box solutions.
Thank you for that. I can say on behalf of all of the senators who have been up here, we're getting a new nostril tore into us in our local communities in terms of banks and what the community wants from the banking industry. We have to figure ways of responding. Sir, I'm glad you were able to be here, and all of your points were fascinating and horrific, sir. Your work is horrifying, but it's well done, describing a situation. What would you recommend for New York State? I see that you have come up with, you glanced at it, you spoke of how Maryland, I believe, has come up with an appraisal gap for historic financial assistance programs and, of course, the baby bonds. What would you, if you had the deputy superintendent of the state of New York's Department of Financial Services sitting in front of you virtually, what are the policies that you would recommend that New York could pursue for equality of opportunity, sir?
Yes, and I believe, in some of the things I laid out, I don't believe all of this would come under the Department of Financial Services, but I could be wrong about this. But I do think if we're talking about how do we get better service of financial institutions to communities of color, to low wealth people, we really have to address the low wealth aspect. It's not just looking for outright racial discrimination. It's, I think, what has been the cause is ongoing asset poverty in communities, and financial institutions aren't designed to deal with that asset poverty, and even getting a little bit beyond the low to moderate income to really look at the differences in wealth. As we noted, there's substantial differences between Blacks and whites and Latinos of similar income in terms of wealth. And if we aren't designing products and aren't designing legislation to address those differences, which we haven't been, I think it is why we have maintained on this path of inequality. So I do, look at it being very holistic. I think it is great that financial institutions the last few years have been saying they're committed to racial equity, and they are going to, add to some subsidies, recognizing that part of their own procurement practices, part of their hiring practices, it's not just lending, though we do need to hold them accountable in lending. It's also as community institutions that are serious investors in community that we have to push them forward, and then push the policies of the state and local jurisdictions to create some of these policies that other areas are exploring. It's going to be it's a long-term effort, but I do think some of these issues that we laid out can get us on the right path.
Well, I want to thank you, sir, for appearing today, and I look forward to calling you back to the witness chair on another day. And I do want to thank our deputy superintendent and to thank DFS as a whole, which I have a very good relationship with DFS and its brilliant commissioner, the superintendent. I will allow you to get away for a moment. We'll bring you back on another day. I hope it wasn't too unpleasant for you.
It was a wonderful experience. Thank you for all your thoughtful questions.
Well, tell the superintendent you survived it. Would you call the next panel?
Okay, the second panel, with John Witkowski and William Mellon come to the table.
you back.
Same taxpayer somewhere.
Sure. That's a baker. Money to be made. Again, it's always a joy. I should take a moment to say that I have learned so much from both of these gentlemen, even as you start a process where you believe that you know all of the truth. And in the journey, you meet some people who are able to give you more of the truth, give you to show how much of the truth you have yet to learn, and both of these gentlemen have been very good in that. Let's see. Oh, I'm not going to choose. I'm going to let you guys choose who goes first. Flip a coin.
John, you want to go?
I'll take it.
Good
Well,
to see you, sir.
He was listed first, so I just.
There you go.
John was listed first.
It's the first time the alphabetical order didn't affect me. It's, good afternoon. Thank you very much for having us, Senator Sanders, Ranking Member Borrello, and Senator Tedisco. We appreciate the opportunity to speak in front of you today. My name is John Witkowski. I'm the President and CEO of the Independent Bankers Association of New York, which exclusively represents the interest of community banks in New York State. The hearing notice lists the topic of this hearing as explored disparities in the New York banking industry. And based on some of the comments that have been made, I'm hoping that this will provide some, at least thoughts and ideas of how we can help with the situation that we're in today. New York State has a wide range of banks serving a broad mix of communities, urban, suburban, and rural. New York's banking industry consists of community banks, regional banks, globally systemic important banks, and foreign banks. Newark banking system supports international Wall Street and Main Street transactions for all sizes of customers. Despite challenges in the commercial real estate sector, in some of the real estate sector, the banking industry in New York remains strong. The diversity of the banking industry in New York and the United States is unique as compared to many countries which rely on large banks. These large banks dominate their local and economic landscape. The number of banks and the availability of different services, particularly for small businesses and communities, is a strength to the banking system. Racial inequalities and low-income disparities should not limit access to banking services and deposits. It's more expensive for the low-income individuals who use alternative financial services to cash checks, pay bills, and obtain loans. The problem of unbanked and underbanked is widely acknowledged. The important consideration for the Senate Banking Committee is what policy changes would be helpful in advancing access and inclusion for traditionally underserved communities. As the data demonstrates, this is not a New York issue, not just a New York issue, it's a pervasive issue nationwide, and we've heard that from a couple of speakers today. Underserved minority communities will be best served by expanding the number of minority deposit institutions that are in New York State. MDIs are best equipped to overcome the distrust in many minority communities of banks. MDIs operate with offices in minority communities, providing direct access to the community members. They also, like all community banks, lend to businesses in their communities, playing a critical role in providing credit, capital, and financial services to low to moderate income minority communities. Minority deposit institutions understand the community's needs and can focus on products and services to aid their economy and encourage community members to become customers to participate in the financial system. The legislature should consider legislative enhancements to encourage the development of more MDIs in New York State, considering the unique model of MDIs and the challenges in serving a low-income community. The following are suggested. MDI should not be required to pay any bank taxes for the first 10 years. This delay will enable MDI to establish its presence in the community and reach profitability. MDI should be exempt from documenting compliance with CRA requirements for the first 10 years. This would also eliminate a regulatory burden which serves no compliance purpose. The Banking Development District statute should be amended to specifically include MDIs. And we know that the Banking Development District has been expanded over the last few years, but hasn't been really an advantage to many of the banks that are coming in. New York State DFS should establish a mentorship program for MDIs with other banks to provide technical assistance in products and services. DFS should affirmatively encourage assistance to help an MDI develop a successful business model. MDI should be funded through an Empire State Development Capital Access Program, working in conjunction with Pursuit, formerly known as New York Business Development Corp., to build a small business loan portfolio which has a loan loss insurance coverage. And we've talked about that, and we passed that bill last year. Sony Mae should establish a program which enables MDIs to have access to Sony Mae insurance for mortgage loans to first-generation homeowners. This program will be directed at helping minority communities establish intergenerational wealth. MDI should have access to state deposits as provided for in the S6271 and A5521. Deposits are difficult to attract in any community, but particularly low-income communities. The ability of MDIs to make small business and other loans is a function of their ability to attract deposits. State deposits are a critical component for expanding MDIs. For MDIs to operate profitably in a distressed community, legislative, regulatory, and financial support is necessary. Supporters of improving financial services in minority and distressed communities should focus on the ability to expand small businesses, home ownership, community stability, and financial literacy through MDIs. MDIs provide a clear alternative to improve financial services in underserved communities. Access to financial services is dependent not only on bank availability, but also on the financial education encouraging the use of checking and credit cards. S5669 Sanders and A6924 Hunter recognizes that the unbanked do not generally visit banks to obtain financial education. However, many unbanked and underbanked do participate in government programs such as SNAP and HEAP. This interaction provides a contact point for education on the benefits of having payments made directly to a checking account. This bill will require a study of the opportunities available for the state to positively reinforce the use of the financial system. Under this legislation, the state serves as an intermediary to encourage the adoption of sound financial practices when interacting with the unbanked or underbanked. Banks need to continue to assess and respond to the barriers which drive customers to use alternative financial services rather than mainstream banking services. The banking industry should design products to compete with alternative financial services. For example, the Bank On account is intended to offer a simple transaction account which does not charge a customer fee when the account goes negative. Bank On is designed to address the concern about overdraft fees in cases where there is insufficient funds and lack of savings to act as a buffer. Financial technology provides convenient access to many financial products and services. Many banks are offering mobile banking services. A nearby branch or ATM is not necessary for many banking transactions, although it is something that we should really desire to see if we can start to build new branches in some of these areas. New loan products have been introduced based on risk assessment data gathered from small dollar fintech loans. Expanded product offerings and financial education opportunities make fintech a vehicle to expand financial inclusivity. Fintech deposit accounts can be structured with low maintenance fees and no minimum balance requirements. Data collection is an important consideration as it allows banks to determine risk factors involved in potential products. Some banks are launching digital-only brands separate from the bank's own brand to take advantage of fintech. As fintech evolves, it should have positive impacts on the unbanked and underbanked. Albany supports the adoption of positive solutions to address banking communities populated by the unbanked and underbanked. Encouraging the expansion of MDIs provides a brick-and-mortar presence in underserved areas. MDIs give these areas the opportunity through minority ownership to connect with the community and encourage full participation in the financial system. Other proposed solutions like state or municipally owned bank or financial services provided through a state agency like the DMV do not provide the same direct economic impact as an MDI does through its ownership, jobs, and community connection. Minority banks are committed to stabilizing neighborhoods, providing small business loans and other financial products to improve lives. The community bank model of service to their community provides a proven pathway to success if adopted. And I say this with all due respect to all that are here. I think it's important to realize that we do have very successful MDIs and CDFIs in the New York City area. Abacus being one, Ponce Bank being another, and Carver Bank being another, that are very successful in working with their communities and doing a great job. We need to expand that opportunity, and we need to get people involved in those communities to make it happen, and also legislatively be able to fund those new opportunities for these MDIs to make a presence and be successful.
Thank you. Bold, thank you. Sir.
Well, thank you, Senator Sanders and Senator Borrello and my own senator, Senator Tedisco. Thank you for inviting me here today. Can you hear me okay? I feel like
Yes,
I'm-
now especially.
I'm sorry?
Louder, and we'll make it work.
Louder. How's that sound?
That works.
All right. Well, thank you again for inviting me here today and be part of this important discussion. I'm going to jump to page 8 of my remarks today. You did get a summary from me, written documents, and it does lay out a lot of the great things that I think New York State credit unions are doing across this the state of ours. I should have introduced myself anyway. I am Bill Mellon, president of New York State Credit Union Association, representing about 300 credit unions across the state, 7 million members that are being served by them. We have credit unions that vary in size in New York from $1 million to over $10 billion. Most of our credit unions would be classified as small credit unions in New York State, meaning that they are less than $100 million in total assets. Most of our credit unions are federally chartered institutions. About 90% of New York State credit unions are federally chartered through the National Credit Union Administration, and about 10% have been chartered by New York State and with their principal regulator being the Department of Financial Services. I want to jump to just some of the things that I wanted to share with you that I think you folks have an opportunity to make a difference in addressing the disparities in New York State. And I echo John's comment when it comes to MDIs and the CDFIs. You know, several years ago, New York State developed its own CDFI fund. But to this date, there has been very little funds driven in that particular direction. There's opportunities there to fund more, to do more. Most of our credit unions that use CDFI funds come from the federal government. I suggest, senators, that you look into ways of funding our own state CDFI fund and giving community banks and credit unions more opportunity to put those public dollars to work and helping address the disparities here in New York State. Number two, Senator Sanders, you were a leader in 2019 when you allowed credit unions the opportunity to participate in the banking development districts. I thank you for that. The program is a great program. However, the burdens and the regulations to get involved with the banking development district are almost too impossible for most of our credit unions to participate in. They tell me that they try. They tell me they start down that avenue. They tell me they meet with the DFS, and I don't mean to be painting DFS in a negative fashion whatsoever, but the burdens of becoming a banking development district credit union or opening a branch in those areas is overwhelming. Absolutely overwhelming. Can you hear me? Okay, good. Oh, good, thank you. So, you know, we have a couple of credit unions that have gone down that path. Hudson Heritage was mentioned a little while ago, I think by the DFS. That's a credit union that was our first credit union to become a banking development district participant. Sunmark right here in the Capital District is another one. Bethpage on Long Island is now in the process of doing it. But even Bethpage, a $10 billion institution, says to me, Bill, it's not worth it. At the end of the day, it's just not worth all of the time, money, and energy it's taking for us to get there. And this is the largest credit union for us in the state of New York. So if they're saying that, what does that tell us? It tells me that it's a great program, but we just can't get there to use it. So I would ask you to revisit that, maybe study it, maybe ask the DFS to come back. How can we make this program more accessible to financial institutions, credit unions, and community banks? I'm going to go back to something else that I was thinking about before I got here, and it doesn't necessarily realm under your committee, Senator, but it's education, financial literacy. I think this is one of the biggest obstacles, problems that New Yorkers have when it comes to access to financial institutions, because they don't understand it. They don't understand the difference between a check casher and a community bank or a credit union. They don't understand really where all the fees are going, where all their money is going. I think if we go back, like everything else in the world, in our society, go back to the basics of education. Do our kids, are they getting out of school understanding the basics of financial literacy? And I think when we go into our low-income minority communities, the answer is no, they don't. So I would again encourage our state elected leaders to look into, I don't want to use the word mandatory, but I think our schools could do a much better job in bringing financial literacy. Partner with community banks, partner with credit unions, have us come in, have us talk about what financial literacy is. We have a program called Financial Literacy Fair. Quickly, I'll just describe it. So every participant, every high school kid gets a card that has an income on it for the month. And some are lucky, they get a lot of money, income, some are not. But they take that card around to these various stations in the fair, and each station, they have something to do with that amount of money. Let's say it's $1,000 a month, $2,000 a month, whatever. So the first place they go to is pay their rent. Charge it out. Next where they go to is pay for their groceries. The next place they go to is decide how many times they want to go out to dinner for the course of the month. The next place is, do they want to save to go on a luxury vacation or an economy vacation, whatever the case may be. And every time that they go to these different stations, that money goes down and down and down and down. At the end of the day, there's another station that says, how much you want to save toward retirement? And they look at how much money they have left, and they don't have any money left. And it's just a great awareness of how they need to manage their funds. And the reactions have been really outstanding in that regard. Senator Sanders, I know we've talked about this many times, but my next suggestion is I'll give municipalities the option of utilizing a credit union for their municipal deposits. Have a relationship between the financial institution, be it a credit union, and the municipality. We talked about this a little while ago. How are those funds being utilized if I'm the mayor, if I'm the mayor of Saratoga Springs, Senator, where I live, I want to know if I'm Adirondack Trust or if I'm Bethpage or Broadview Credit Union, how are those money being reinvested into my city? How are they helping my lower income people, my minorities in the city of Saratoga Springs? Those are the kind of questions I should have it asked. But I think we should let them decide, let the municipalities decide, is a credit union a better option for them to utilize their money? Is it a better option for them to keep the money local? So I'm not looking that way. I think from my comments, I was a banker. I don't have any. I think we all have a role to play when it comes to financial services. I really do. I was sitting on a panel yesterday where we're celebrating the 50th anniversary of Inclusive. You might know it, but it's a great organization that's really helping low and moderate income communities get to a better place financially. There was two bankers on this committee with me. One from Citibank and one from, I forget the name of the second bank. But anyway, my point is that we're working together. We're working together at one table to address the disparities here in New York State. And then regulations. We heard about regulations. And as I said before, we have credit unions that are $1 billion, and we have credit unions that are $10 billion. If we have regulations, we need to not paint all institutions with the same brush. What regulations work for a $100 million credit union is not going to be the same, perhaps, as a $10 billion credit union, right? We understand that. But we also talked about how many branches and how many financial institutions we have. When I started here at the New York State Credit Union Association 20 years ago, we had over 700 credit unions in the state of New York. Today, we're down to less than 300 credit unions. And when I asked the boards of directors, and I talked to them, I know them after all these years, why are you deciding to fold your tent? And the number 2 reason is we can't deal with the complexity of the regulations that just keep on coming and coming and coming at us. We no longer can do it. We need to fold. We need to go into another institution. And I think as you look at all the regulations, and they're all meaningful, right? You're all doing the right thing, but keep in mind the other side of what's happening here. You're having an impact on decreasing, at least in the credit union land, and I would guess on the small bankers are the same thing. Regulations are killing a lot of credit unions and a lot of financial institutions. So yeah, regulations are needed and important, but keep in mind what the adverse reaction is going to be when you place a new regulation on an institution. And then lastly, when I talk to people are like, incredible credit unions like Lower East Side people, Brooklyn Cooperative. We have so many incredible credit unions that are doing amazing things. They tell me, because I told them I was going to be here today, and they said, Bill, when we talk to a new consumer, maybe a new member that's looking for a relationship, they generally find that that individual does have some type of banking relationship, whether it be a credit card or a loan or something, but it's not working for them. And it's not working for them, I think, is because they don't have a relationship with that bank or financial institution, excuse me. And I think that's paramount, right? We all know trust. You got to trust. If I'm in trouble financially, if I've gotten myself into debt, if I have gotten myself into a bad credit report, what do I do? If I go to some financial institutions and I tell them how bad my credit is, well, I'm gone. Then they're not going to do business with me. So I guess my point is, Senators, is that I think we do have a lack of services, but I think it's more important because we don't have the right relationship. We don't have the right institutions doing this. Credit unions are not-for-profit cooperatives. Our whole mission in life, our whole purpose in life is to bring financial well-being to consumers. We mentioned check cashers. I understand. I have friends of mine that are in the check cashing business. Again, I have nothing against them at all. But a lot of minorities, low-income, underserved people use check cashers. Why? Why do they use check? They know they're paying higher fees. They know it. You know why? Because they trust the check casher. They're not going to be embarrassed with the check casher. They understand the rules and the regulations. So they go with the check casher. They know the check casher. Yeah, they know they're paying higher fees. But it's a level of trust that they have. So banks, credit unions need to develop that same level of trust, where they can come to us and cash their check for free, where we can give them some financial guidance to get out of debt, where we can help them build for the future, where we might be able to save some money for retirement. That's not the role of a check casher. Check cashers do their job. They do transactions. We go far, far beyond that. But why? We need trust. And that's what the check cashers have, and that's what we need to work on, with your help.
Thank you very much. I'm looking forward to my comments, but I will yield to my colleagues, Senator Borrello.
Thank you, Mr. Chairman. Thank you both for being here. I think you both touched on the regulation issue. Okay, so we're here to discuss underbanked communities, of those folks who are underserved. But what I see, in particular in our rural communities, is it's a cost of doing business, and the regulations are the hoops you're jumping through. So I wonder if, and I guess you can both maybe briefly speak to this, is that the foundation of the problem here? Are we trying to, how about we start from the bottom up and talk about deregulating and freeing up your ability to do more business in more areas? Would that solve this problem, or at least start to address that problem?
Yeah, I think when you look at some of the regulations that come out at the state level, I think they're a little bit over the top for some of the smaller banks, some of the community banks, no doubt. I think it puts a stop to what they're doing to look outward, and it keeps it inwardly focused. So they're worried about what the exam's happening, they're worried about what's going on internally instead of going out and really drumming up the business. So again, being a former banker myself, I can understand, and back in the 2007, 2008, and 9 era, knowing what inwardly focused means you're not really going out and generating the kind of business. And I think every time a new reg or guidance comes out, And again, this is nothing against DFS. I know they're doing their job, but it's just one of those things that now these smaller community banks need to focus on what the next shoe that drops, and the next thing that happens. It's definitely one that the resources, the time, and the amount of work they put into getting that to make sure it's done, and not sure where it ends up or how long it takes to review and get their exams back. Again, this is not a knock. It's a tough job that DFS has. I don't, but it's one of those things that every time you see something come along, you're like, okay, we're going to get some pushback.
At the end of the day, the DFS does what they're tasked with doing.
Tasked to do, right.
Yes, exactly. So
Yeah,
Mr.
well,
Miller?
Senator, I do agree. I would use my example of my financial literacy fair. I talked about, there's only so much money to go around. And if you're running a credit union, maybe a small shop credit union, you got your revenue for the month. Where am I going to use it? And more of that revenue now is going to pay compliance officers. We own the association owns a mortgage company that works with small credit unions. I ran that company 20 years ago. I had 0 compliance officers in that company now. The company's not much bigger than it was back then. I have 4 people now that are dedicated just to maintaining our compliance requirements. 4 people that I'm paying a salary to, that I could take that money and put it to, in my mind, better use. And I agree, DFS has their job to do. But I think we need to look at the cost, the adverse impact of the regulations. I know you guys always have good intentions. I always say that. But sometimes it doesn't work.
Yeah. And I agree with you. We pass a lot of bills, we create a lot of laws, and that leads to a lot of regulation. And I think that's the point of my line of questioning is freeing that up. We have a small shop credit union. We have several in my district, but the Southern Chautauqua Credit Union that does that program,
Yep.
the financial literacy
Yep.
program, they're
Yep.
in the schools.
Yep.
Yeah, and they do a
Yep.
great job there.
Yep.
And they're teaching kids that financial literacy and the responsibility.
Yep.
So those are I'd like to see you do more of that and less of, nothing against your compliance officers, but
Right.
yeah,
I
I
agree.
understand. More and more people are having to hire compliance officers in general, not just in your industry, but every industry,
Yes.
because there's so many regulations and there's so many, highly punitive penalties. I want to go back to Mr.
And Senator, I just
Witkowski.
mentioned Southern Chautauqua is a CDFI credit union now, and they're doing amazing things.
They are. And they're expanding in our area.
Yep.
Yeah, so, I want to go back. You touched on the MDIs and your suggestions, which I think are very good suggestions for the MDIs. And when you start talking about suspending the fees and the taxes that they have to pay, I mean, we're just basically you're basically saying let's do what IDAs do for new startup businesses in the area. It's right.
It's a
kind of
startup business. It's
Yeah.
absolutely, and it's a startup business that you have to get the right people involved to get it started and get it going in each of those minority communities.
Yeah, well, and also to that end, again, I was a county executive in Chautauqua County. Obviously, I was also prior to that I was on the IDA board, and interestingly enough, they gave us a rather generous allowance of bad loans. You want to take risk, right? You want to take risk where other people are not taking risks. Is that kind of the model here in your suggestions that, we realize that these are probably going to be, in some cases, riskier ventures, which is why we don't have others operating in that space right now.
Right.
Do we need to give them the funding and essentially the leeway to be able to take those risks in areas that others are not?
And if you see, part of the testimony is to also bring the state funding into that, to give them a head start on that.
Yes.
But, you have the Pursuit, which is New York Business Development Corp., who does this today as far as handling minority and women-owned businesses, and takes that additional risk that banks won't take because, again, we talk about regulation, right?
Right.
So when banks take on a little bit more risk and it goes south, they get their hands slapped. So again, it's kind of it's a fine line. But if we put specifics around what MDIs can do and what the Capital Access Program can do with Pursuit, the New York Business Development Corp., I think that in itself would give a lot more leverage and a lot more opportunities for MDIs.
So what you're saying is it's not so much about changing your practices as much as it is about empowering these MDIs, giving them the latitude that you, like you said, you can't have a certain percentage of bad loans. You can't take risk in certain areas. Why not empower these MDIs and supercharge them to provide those services? That is perhaps the solution.
Right.
You would both
And
agree?
community banks and banks would be more than happy to provide the training and to be involved in that. I think that's a big part of this, is
So
to
you-
make sure that you have the right process and right operations and give guidance.
So between DFS and even the organizations like yourself, you would help mentor some of these folks
Absolutely.
to get them off the ground. Great. All right. Thank you very much.
Thank you. Senator Tedisco.
Thank you so much, Chairman, and thank you, President Witkowski and President Mellon. I want to weigh in. I heard you both speak, and I know you agree on several issues, not so much on some of the other ones, but basically several issues you agree upon. And I want to weigh in on two issues that you've already discussed. I know President Witkowski, you talked about the importance of education. President Mellon, you talked about the importance of literacy and in terms of education for banking. Very important. And probably the best place to start that is with our youth, our young kids, our schools. And then we got into regulations. Let me address that issue first. We get, as you know, I've been an elected official for a while here. The worst call we get is from a constituent who calls us up, whether you're an assemblyman, a senator, governor, no matter what you are, and says, Senator, why did you vote for this bill? And then, I won't mention any bills, it goes into a litany of what the bill did to them. And what I says, I don't remember voting for that bill. Well, here's the number. I go back and look at the number. And this is what the problem is in the situation. Believe it or not, we have some pretty good ideas, pretty smart fellows here and ladies and gentlemen here, that do come up with some pretty good ideas, policy issues for banking, you name it. Sometimes not so good, but a lot of times some very good ideas. Come up with an idea. We don't write the bills, but we sure read them. We let our attorneys read them, our counsel read them. But something else happens, because if you look at the end of most of these bills, it will be sent to a commission or agency to promulgate the guidelines and the regulations to implement this bill. When they promulgate that in the guidelines, they never come back to us, the bill we put together. It goes out into the hemisphere there, the atmosphere, and gets to the constituents. That's when we get the telephone call. Because there's one thing we miss out on, and it's a bill I have pending. Pretty simple bill. Anytime it says at the end an agency or commissioner head will promulgate, my bill says then those regulations and guidelines come back to the last committee it emanated from. And when these individuals we know of are going to be affected, we call them up. And we say, here's some guidelines and regulations that kind of concerned us. Didn't know about it, but this is the way this is going to be implemented. What do you think about it? We don't do that. That never happens as far as I'm concerned. Maybe some people have insights to the commissioners. They call us back and say, how do you want to do this? But not so much, I don't think. And that's a problem, because it's a good idea for the consumer, it becomes a good idea for the banking and credit union industry, and it turns into something that has a double-edged sword. Now, maybe, I'm not saying we don't have regulations and guidelines. Don't get me wrong. We need those. But we need to do them right and appropriately. And sometimes we end up doing more damage than good from a good idea that's not put into place. It becomes overbearing from, I have to say this, a faceless bureaucrat who is not accountable. Because when they call that agency, I don't give a rat's tail. I'm not an elected official, but I am. Mr. Sanders is. Borrello is. Mr. Anderson is. We care. We want to do the right thing. So I understand your pain, and I think we could short-circuit that. I don't think it would take that much time if these agencies, after they put the regulations and guidelines in place, send them back to us and say, well, at least take a look at them. You know, for each one. Let us weigh in with them on how they're implementing this. What's your feelings on that?
Jonathan, I would say, Senator, I love the idea, and I would, you know what? I'd ask those people that you've just been talking about that were impacted, perhaps in a negative way because of your good intentions, have them sit right here.
Yeah,
And tell them your story. So we passed the law, it was implemented by the proper municipalities or whoever. How did it impact you, Bill Mellon?
right.
And listen to them.
Yeah.
And because I think you're going to hear a story that you, many times, are not the story you want to hear.
Yeah. Secondary, you talked about education and literacy, so important. I cut a lot of ribbons in New York State. I'm surprised of the out-migration that's taking place, because I'm every week cutting ribbons at businesses and people, but people are kind of escaping from here. That's why it's important we have these hearings on all the policy issues, especially banking. It's so important. The most exciting ribbon cutting I think I had in a long time was at Shenandoah High School. You know what they did there? I believe it was a credit union. They implemented a credit union outlet in Shenandoah High School and let the students be the tenders there to a certain degree part-time. So, you know, I was a basketball player. I practiced very hard. I couldn't stay on television and watch the NBA and become a good basketball player. I had to do 1,000 jump shots every day, wear ankle weights because I was 5'8", you know, be able to grab the rim with two hands because I was out there. We got to get kids with hands-on experience. And is there anything we can do from this side to help you? And I don't know, maybe it would be a good investment to have the one or two in some of the schools to get the banking going. It would be a good thing for the agencies and the credit unions and the banks and the kids, because they were very excited. We cut the ribbon. They're going to be watched by the professionals, and they're going to understand banking and financial and savings and mortgages and things of that nature. Ankle weights, yeah.
There are many programs out there that school districts do take advantage of. The issue is its cost. When you start to build a branch in one of those high schools, or you start to, you know, it ends up costing both the bank and the school a little bit of money. Well, money well spent. I did one back in the Buffalo market with two of the high schools back there, and it worked out very well. I mean, it was really something. The kids were hands-on. They took in deposits. They gave out cash. They had a small ATM in there that the bank, you know, actually put into the school, which was a great program because now the kids started to use it and had to understand. Obviously, there was limitations to what they can do. You know, $10 or $20 all they could take out if they had money in there. But it was the actual hands-on operations of actually doing the banking need, branches, tellers, understanding what's going on, and just the basics of banking, making sure you balanced your checkbook and you knew what you had in your account.
I know we have them in grocery stores.
Yep.
Yeah.
You know, and they must be doing financially pretty well when they have banks and credit unions and grocery stores, but they don't do well financially to any extent, really.
It's not a profit-driven, as John indicated, but it's extremely valuable. And I you know, you mentioned Shenandoah. We have there's all kinds of school banks that are across New York State that we generally do not do cash. So, you know, you come in, you do your transaction, and then you might get a teller check of some kind, and if you're making a withdrawal, and then you go to your local community bank or credit union to charge to cash it. So we have that safety situation in check. But folks that have gone, we have a program called Young Professionals, and some of those young professionals tell us that they first got introduced to credit unions through a school bank, where they were actually working as a teller or a customer service rep in their high school, helping their fellow classmates open up accounts, save for college, things of that nature. So it's a great program, Senator. Let's do more of it.
What could we do? Provide a grant or for schools, or?
I think, personally, I think it's more of the school system. And again, a lot of high schools have business, but one of the classes they don't really teach is the basics of banking, right? And that's one of the things that I think is very important for all high school kids to go. There was a 4-year curriculum that they had in the high school my kids went to that each year took on a different level of finance. And they took it as an elective, you know, but it was one of those things that for 4 years, and they understood commercial lending, understood the banking, they understand a lot of different parts, credit, and understand accounting class too, you know, basic accounting, but it was just something that they started to understand the numbers, and it was well received. It's just a matter of getting into the school districts and have them create that curriculum I'm not blaming the school districts, they got enough on their plate too.
Yeah, they got a
But it's
huge
just one of those
curriculum,
things where
yeah.
if you can sit there and mesh it together, it would be great. If we get something from the state that would help us do that, I think it would be a fantastic idea.
Thank you.
You know, if I could just interject, is that okay, Senator? Absolutely. So I just, it's a little bit of a stretch here, but I think what you could do is enhance the state charter for credit unions and banks, and let us have a closer relationship with our regulator. The DFS has the same purpose as at least credit unions, and I bet community banks. They have a mission, a purpose of bringing financial well-being to more New York Staters. If we have a strong state charter, we have an opportunity to be a better partner of our principal regulator here in New York State. And years and years ago, 90% of the credit unions in New York State were state chartered institutions. And over that period of time, now we have less than 10%. And it was because of regulations that led them astray to the government. So I think, Senator Tedisco, one way we could do this in a roundabout way is strengthen the state charters, let us partner with the DFS, and let us move all of these initiatives forward together.
Thank you.
Assembly member.
Thank you so much, Senator, and thank you, Mr. Millen and Mr. Wachowski.
Yes.
Got it right. For joining us today for this hearing. So I have a couple like yay or nay questions, and then I'll get into
Yes and no's?
yes and no,
Okay.
rather. I think I'm voting right now. Yes or no questions, and then I'll ask the meat of my questions. Hopefully I have enough time. So I think you mentioned in your testimony that 95% of credit unions are state chartered.
Federal charters.
Or federally, so other way around, federally chartered.
If you go back in time, you're correct. But no, today, 2024.
And of those 5%, how many are in your association?
I think all of them.
All 5% that are?
Yes, as far as membership is concerned.
Okay.
Yes, I'd have to check, but I think so, yeah.
Okay.
Yep.
And in terms of the report that we're discussing today, that's issued by DFS, I'm just wondering what products are available for underrepresented communities, households that earn or earn less than $15,000 a year or as much as $75,000 a year. So that sweet spot. What products do your memberships offer that constituency?
You know, as far as products are concerned, I think the products are all pretty standard, Assemblyman, whether it be a product for a middle-income person versus a low-income person, but it's the way it's going to be implemented. It's going to be the fees that are attached to it. It's going to be the financial education that goes along with it. So at the end of the day, I think we try to earmark our products and services directly to the consumers that we're being served. But if you drill right down to it, you got checking accounts, you got savings accounts, you got credit cards, you got debit cards, you got loans.
Sure.
But making them understandable and affordable to minorities and to low-income people is what we need to do.
So you'll say that that's something that you're growing in as an association in terms of offering products to that constituency of people.
Yeah, I think credit unions in New York State do a great job. Some do more than others, but I think they have an array of approaches to offering financial services to their communities.
Okay, let me see if I can try to squeeze this one in. I think you mentioned, Mr. Mellon, the need for more financial literacy programs, and I'm just wondering, of course, your members are beholden to the CRA, Community Reinvestment Act, or Community Reinvestment Act there. So I'm just wondering where there is overlap to be able to provide some of those programs through your institutions that are members of your association to be in compliance.
So programs that are CRA-related programs, I'm not sure.
So again, like when we're looking at the CRA, there's a requirement for some level of community engagement, community outreach, particularly communities that are underserved and unutilized. So I'm just wondering if there are any programs that you all are using within your toolbox to be able to help meet the needs of that constituency? Because it hits twice. You're able to meet the needs of that constituency. Oh, sorry.
Point of information, the credit unions are not held to the same standard of CRA.
Gotcha.
They don't have that.
Gotcha. Thank you. So
Yeah, yes, but you're right, by the nature of our field of memberships, we don't have a community reinvestment. We measure everything that we do, but we don't have CRA.
understood. And maybe that's for you then.
Yeah, CRA banks have very strict CRA requirements. And yeah, we invest back in the community, and not to get into a battle here, but when you look at the municipal deposits that come from each of the municipalities, that's also part of our CRA piece, where we actually invest our money back into the communities by, if you got a new fire truck, you need school district, you need extension, those are all things that banks do based on what the municipal deposits come in, because they can use that money to loan it back out again.
Borrow against it, use it. Okay.
Yeah.
So that was a question more for you, Mr. Witkowski, than Mr. Mellon. Okay.
So we look at that, and that's why one of the options I had in my testimony was to look at the state level funding, that not at the municipal level, but the state level, that would allow credit unions to be a part of that if they needed deposits.
So when you say funding, you meant deposits,
Mhm.
state
Yes.
deposits.
Yes.
Okay. Okay. That's all. Thank you. Thank you, Senator.
Further go down that road of CRA, and to alert you, I have not questioned my colleagues on the board, but I personally am not interested in expanding the state's role with the credit unions until I hear of a CRA that the credit unions are going to accept. This is the money of the people of New York, of course, and while I appreciate that credit unions focus on their members, and their members come from all over, the monies of the New York State are open to all, and under those conditions, I'll be kind and just leave it like that. A couple of points. I've had the fun of having conversations with John. I bring him to places and I beat him up. He brings me to places and he beats me up. So I don't have to have a lot of conversation with John. I'm going to focus with you today, sir. Let's see.
I can bring you to places.
Well, I'll give you cause to beat me up in those places in a moment. Just some humble differences with you, sir. You spoke of that trust led the poor to check cashing. I would humbly differ with you and say, sir, access leads the poor to check cashing. If the poor had a place, and the poor do know the difference between fees and no fees. The poor know the difference more than anyone else. They know that if they go to here, they don't have to give that $2 to $5 that they're giving over here. They only go over here if there's no over here to go to. The low income, we'll use that word, it's kinder, I guess. The low income have no romantic attachment to check cashing places. They're going wherever they can cash a check. They're going, and if you tell them, hey, over there you don't pay a fee, you will see this dry up so quickly, because there may be people in this room where $2 to $5 has no meaning, or I'll be kind, has less of a meaning. But when you are at the edge, you're really counting pennies, $2 to $5, you could do a lot with that, and the poor are actually quite remarkable how they survive on so little is a thing that books have been written about. They're a little bit more wise than we may know. I would suggest there are other reasons why they are where they are poor. It's not simply because they didn't get a class in school, and, you know, had they only received, taken the Wall Street game, that was one of my favorite ones that I know about. If they only took the Wall Street game or some other class, they wouldn't be here. You did not say that that's the only reason. I'm not, I'm using you perhaps as, I'm having too much fun at your expense, and you'll forgive me, but it allows me to make a few statements. The poor are a little bit smarter than we're giving them. Give them some options so that they can take some options. And going back, I really have been speaking to you guys about a CRA, and my friends in the banking community and other communities have pointed it out to me in no uncertain terms. And you know what? They're right. We've got to, if you want that money from all over, from the state money, then you've got to accept an even playing field for that type of money. And in fact, let me encourage both of you guys. The issue of regulations, let me go two different ways to it. First, let me say that regulations, at least those around the issues of race, have been in a response to discrimination. No regulations, I've seen what that does. That's the past that we're coming out of. It was not a good place. Let me accept that both of you agree that there may be some good regulations. Let me not make you into some cartoon character. There are some good regulations, and no one wants to return to a place where there's no regulations, but we all are saying, in fact, everyone up here should be saying, we need to look at these regulations again to see which ones impede business, which ones are unnecessary, maybe have aged out. Maybe they were good at some point, but they're not good now, and we need to look at it. New York City actually led an effort on this some years ago when I was on the city council. They sat down and looked at all the regulations that there were, and we got rid of hundreds, as a matter of fact. We had regulations about horse and buggy, how many could go in a certain place, and we got rid of hundreds. And perhaps we need to do the same here. So I encourage you all to bring me regulations that duplicate, that slow you down, that have no real, are not doing what they want to, what we want them to do, that there may be better ways of doing, etc. And I assure you that I will move on it faster than Senator Tedisco would. I will show you that the Democrats can move against regulation faster than my Republican friends, and that's a inside joke for those who understand politics. We are accused of loving regulations a little too much, and they have not seen one that they love yet. So the truth is somewhere in the middle. It's somewhere in the middle. Sir, you wanted to respond?
Yes. Senator Sanders, I think that's a great idea. The one thing that I think is a difference maker here is that banks also have federal regulators.
Yes.
Which sometimes they're not on the same schedule, contradictories I shouldn't say it's not contradictory. They all have the same meaning where they want to go. They might have different ways of getting there, which makes for different reporting, which makes now, again, more time, more effort, more work, more resources that banks aren't going out and doing. It's more internally focused. So you have a state, and again, it's nothing against DFS and nothing against the federal regulators. It's just that that's the hard part for some banks. You hear them in January say, oh, I got DFS coming in to do this exam. Now, you know what, the Fed's coming in May. And now all of a sudden, those first 6 months, 7 months, are now based on working with regulators and internally focused and doing. So again, it's not just DFS, but I understand from the state side, it's really a combination of both. And I just want to make sure that I just made that point.
A good point that you pointed out, sir. I am.
Senator, if I could just say, it's the
by me, by all
obviously the
means.
same situation for, you know, it's not an easy lift to be a state charter these days,
Mm-hmm.
because you have two regulators. As John said, it's almost 12 months a year now. You got the DFS in, you got the feds in, you got all kinds of regulators in. So you're really working with multiple regulators. So it's actually more of a challenge, perhaps, to be a state charter in New York State. And I think that's, again, I just ask you to keep looking. Why we look at these regulations that you pass that are going to be impacting state charters, we don't want to chase the other 5% away.
I see you and I raise you, sir.
Okay.
I challenge you, in a good way, of course, to work with us, to bring us regulations that would be best served by accepting the designation, accepting what the federal is doing and saying, if, I don't know, if they want you to report and use a yellow copy and we want a green copy, that we could use the yellow copy too. We can accept things as long as they are meeting the mission that we're trying to do. Bring us some stuff that would make your life easier. And you will find that, and getting serious here, you will find that in the banking committee, I was joking about partisanship a moment ago. We pride ourselves in being nonpartisan once we get here. We really are not interested in party designations. We're interested in what's good for the people of New York State. What is going to make their life better? And you will find, if you can bring us some stuff, you will find that flies through this committee, and we move that into law quick, fast, and in a hurry. I want to thank both of you for coming out here today. Was it as painful as you thought it would be, John?
It was wonderful.
What a shame. Wait, so let's do more. Brother William, I hope that you survived it well.
I enjoyed it. I very much appreciate your time.
We have failed. We have really messed up.
Yeah.
Well, then thank you.
And we share the same goals.
Well, yes, this is true. And to the banks that we invited that didn't come,
Shame on them.
yeah, well, you said it best. All right. Thank you very
Thank you,
much.
guys.
I will see you soon. And we might as well get ready to call. I want to thank Professor Hamilton for staying, and I hope that you saw how we do business in New York State, and I trust that it glorified you and didn't horrify you. But this is what we do. Professor Hamilton, I really appreciate that you were kind enough to be here. And without further ado, why don't you begin your testimony, sir?
I appreciate you, Senator Sanders. In fact, this is one of the more important things I can do with my time, which is try to bring scholarship to the public setting to improve people's lives. So Chairman Sanders and other esteemed senators, thank you for having me today. I am Derek Hamilton, a university professor, the Henry Cohen Professor of Economics and Urban Policy, and the founding director of the Institute on Race, Power, and Political Economy at the New School. I'm going to center my remarks today with a focus on what I believe is our most treasured and productive resource, and that is people, and trying to promote an economy that facilitates people to be their best selves, and then finally government's fiduciary role in trying to achieve those goals. So financial institutions' access to non-predatory finance and financial capital are critical to building an economy that works for all people while protecting and sustaining our environment. This past pandemic and its aftermath reveals a collective public health and economic vulnerability from a political economic system that actively produces inequality, but in plain sight, well beyond class, we see race is a focal point. Many New Yorkers and Black and brown families in particular, they have low wealth, limited access to prime financial services, inadequate health care, and work in precarious but essential jobs with fewer workplace protections and lower wages. We noted wealthier families have financial advantages and they buy crucial additional advantages for themselves and their children, such as the ability to obtain a college degree without accruing the costly educational debt and access to more preferred financial services that are more readily available and come with rewards rather than fines and fees. We noted lack of wealth prevents many families from accessing these advantages, contributing to the ever distance between those born with resources and those born without. You know, it's critical to note that there's never been a case where a white asset-based middle class simply emerged. Rather, it was government policy and to a large extent government subsidy that yielded the finance, the education, the land, and the infrastructure to generate and accumulate wealth and pass it down across generations. We should also reckon with a history in which Black and brown people, their personhood, and whatever capital and resources they may have established, was always vulnerable to government and private complicit exploitation, extrapolation, confiscation, and destruction. And that relates to this conversation we're having about access to finance today. The proactive role that our government has played in determining winners and losers, especially by race, it is undeniable. There's no aspect of our economy that's beyond the purview and the continuous involvement of our government. Yet when we frame poverty and inequality and this racial wealth gap and access to banking, we frame it around poor financial choices and decision making. And you heard a lot of that today in these hearings on the part of largely Black, Latinx, and poor borrowers. This framing is tied to a culture of poverty thesis in which Black people are literally and symbolically presumed to have an undervalue for and a low acquisition of financial literacy and education. That framing is wrong. It's wrong because the directional emphasis is wrong. It's more likely that meager economic circumstance, not poor decision making or deficient knowledge, that meager economic circumstances constrains choice itself and leaves poor borrowers with little to no financial options but to attain and use predatory and abusive financial services. In essence, they know, as Senator Sanders pointed out, that these are bad choices, but they don't have options. In terms of debt, what we traditionally conceive of as good and bad debt, it has different implications when we consider race and class in the prevailing framework that targets politically and economically underprivileged groups with inferior housing and educational products, with predatory finance, as well as our ongoing housing, lending, and labor market discriminations that limit the choice sets as well as the rate of return on home ownership on a college degree based on one's race or ethnicity. We know that Black college students tend to take on more debt at every level of higher education and are more likely than white students to drop out of university because of financial concerns, in large part because of a comparatively lower financial level in which they began. Moreover, we also know that across business cycles, and this speaks to the claims about limited education, racial disparities widen and widen even more for those with higher levels of education, further emphasizing the role of a social identity hierarchy, basically a devaluing in a transactional way Black and brown lives and establishing distribution and sorting, and it gets worse in the throes of a recession. Let me move on. I see that we've lost some people in the room, so let me get closer to conclusion. We use words like choice and freedom to describe the benefits of a proverbial market, even a financial market, but we should recognize that choice is an illusion if an individual lacks basic needs like adequate income, and capital. Markets themselves are political and social constructions. A corporation, a financial institution exists by public charter for which you all define. We're not atomistic agents floating in unfettered markets guided by a free will into fair and efficient allocation. The causes of poverty and inequality are the absence of resources and the political protections to maintain those resources from malfeasance. That is, poverty and inequality are the result of policy choices that deny people the resources they need to live meaningful lives. Incrementalism and changes on the margins aren't going to cut it. We need a profound change towards a more sustainable, moral economy with government interventions to facilitate assets and economic security, engagement and human dignity, and social mobility for all people, regardless of their race, class, gender, sexual orientation, and immigrant status. With regards to financial services, in their 2015 book entitled Fishing for Fools, Nobel laureate economists George Akerlof and Robert Shiller critique the greater good presumption from market transaction by describing how profit motives create incentives, especially in financial service industry, for sellers to manipulate consumers to purchase products, whether or not they are useful for the consumers. There's basically asymmetric information. And I'm not making a case that financial institutions shouldn't exist and don't have a purpose. But to address this moral hazard that I'm describing, as well as the consumer vulnerability, both Akerlof and Shiller recommend enhanced consumer knowledge and greater regulation. I think we should go a step further. I think the public sector should ensure direct provisions of basic accounts and finance more broadly. Households with few assets and lower incomes are compelled to turn to high-cost, unconventional, alternative financial products. They're generally aware that these products are predatory, but they have no alternatives. These last resort debt traps render the recipients indentured borrowers, having to pay higher and higher interest and fees until ultimately they default on the original principal. The sad irony is that those that can least afford finance in the times of their most dire needs end up having to pay the most for this finance. New York needs regulatory mandates and public options that directly compete with and crowd out not all private options, but inferior private options that do not ensure a universal and quality access to banking and financial services. What we do now, it's critical. I'm just going to get to conclusion. We could talk about various policies if that's useful, but I want to remind us that the purpose of an economy should be to promote the productive capacities of all of us, to advance tranquility. That is a purpose of our economy, and to promote human flourishing, to enable people to be self-determining in righteous ways. And the New York State Assembly should exist with a fiduciary to set the rules and steward public resources in order to achieve that purpose. We need industrial policy, we need financial regulation, and we need policies that center people and the environments in which they live, not in a charitable sense, but in a productive sense. It is the best policy approach to promote flourishing and tranquility and provide automatic stabilizations when we have economic fluctuations. Change the paradigm, be bold, advocate for programs and initiatives that truly empower people with economic security, dignity, and an authentic agency and choice to define and achieve their goals. Thank you for your time.
Thank you for that lesson, I guess I would call it, Professor Hamilton. Thank you for it. I have just a suspicion that we will hear from you more in the days to come. I will let Assembly Member Anderson have the first opening.
Thank you so much, Senator. Thank you so much, Dr. Hamilton, for your remarks and your extensive research on the subject matter. If time allows, I have 3 questions. I'm going to try my best to make them quickly, as I know time is not our friend. The first question I have for you, Dr. Hamilton, you mentioned a lot of the disparities that keep black individuals, brown individuals out of the space of the economy, out of the space of commerce, lending, borrowing, etc. So I'm wondering what your position is on public banking and how that institution or entity would help to expand lending opportunities to individuals who traditionally just would not have access to lending opportunities or lending products. That's my first question. Maybe I'll ask all 3 of them together and then. Okay, I have enough time? Okay, good. All right, so if you can answer that, Dr. Hamilton.
Yeah, so I think that is a critical policy that could go a long ways towards setting a base level of floor, a base floor to ensure that everyone has an economic right to a transaction account. At the end of the day, as you heard from the other people that testified, it really is not in the incentive of the private industry to offer these accounts at fair and reasonably priced levels. When they offer them, they often are offered in exploitive ways. So I think that having public banking provides the provision of an economic right to banking, which in the 21st century, it is certainly a critical ingredient if we're going to have economic inclusion, and we can go through the ways in which that's true. And then also, you know what else it does is it reorients the ways in which government exists. You know, currently we have government with a lot of policies aimed at disciplining the behaviors of poor people, aimed at trying to incentivize poor people to do certain things with fines and fees. And we can name a lot of those policies. I would imagine that if government were to reorient itself to provide direct provisions in goods and services that we know if you don't have agency in your life, to ensuring a base level of those resources, and then disciplining the private sector. Basically saying, if you're going to engage in our economy, if you're going to engage with our people, there's a base level by which you need to provide in order to enter these markets. Set a floor on those markets, and then you can have fair and efficient markets and all the benefits that are often advocated from free trade.
Thank you so much, Dr. Hamilton. An extensive answer really hits the home, the points that we're trying to pull out here in the state of New York as we're working through our process. I thank and commend Chair Sanders for his work on expanding public banking, or expanding the concept of public banking access for all New Yorkers through his legislation. So my next question is, you may or may not know of this program, Professor Hamilton, Dr. Hamilton, so you may choose to comment or not around the program specifically or about the concept. But in 2021, New York City announced a baby bond program to provide bonding and savings accounts for young people in schools so that money can go towards scholarships to put them on equal footing, if you will, for finances to support their higher education aspirations and opportunities. That program was rolled out in fall of 2021. I just wanted to get your comment on the program specifically, or of the like. This type of program, how does it help resolve some of the banking issues individuals may have?
Yeah, thank you for that question. And similar to the previous question, we're getting in the domain of economic rights. And I think a goal should be every child born, when they become a young adult, has access to some capital. Right now, that privilege is often reserved only for the wealthy. They establish trust accounts to facilitate the provision of their children to be able to get into something like a home, a debt-free college education, or some capital to start a business so that they can generate wealth over a lifetime and well beyond just generating wealth over a lifetime, have the resources to start a family at a key critical point in one's life when you're beginning to start your adulthood. Most, if not all, of our provisions are grounded in subsistence. We have nothing, we don't have a capital foundation to give people something by which they can build. So, a program like baby bonds is intended to provide a right to capital. It's elegant in a birthright to capital. You know, similarly, we have Social Security that provides a right to pension as we retire and enter the twilight of our life. But in thinking about a lifetime of economic security, we don't have provisions when people are starting out. Now, here's what I would say. I would encourage New York State to emphasize the endowment more in their baby bonds program. I recognize that states are limited in their financial capacities in ways that the federal government is far less limited. But at the state level, the New York State program, the slight critique I would have is that it does not offer a high enough endowment. And if that means making the program even more specialized to target more lower income individuals, I would say do so. So basically, the goal of the program needs to be enough of a capital foundation to actually put the individual in something like a home or an education without debt or a new business. The endowment has to be big enough to achieve that goal. Otherwise, it's limited in what it can do.
But admittedly, to your point, it does set young people onto a path of economic success if those investments are made. But if that child is born into poverty and there's very little discretionary, expendable capital, if you will, in that household, it makes it that much harder to save. Is there any ways that you would recommend that baby bonding be something that has a municipal or state match so that those dollars can go up?
Oh, absolutely. I mean, that you are spot on, Senator, in that focusing on ways in which we can creatively and fiscally ensure that those accounts are sufficient so that people can actually accumulate assets over their lifetime. That should be the focus. And I think there's some lessons learned from other states in terms of the ways in which they're able to find resources as well as finance the program in order to make it have a greater impact. But as a start, I applaud New York and the Assembly and also municipalities for focusing on this issue. In fact, if we want to address intergenerational poverty, we have to deal with wealth. Wealth is not a silver bullet. Income is not a silver bullet. Education is not a silver bullet. Banking is not a silver bullet. But this whole concept of what are the essential things that people need to thrive, that has to be the focus. And we have to do it all because without any of them, we are limited in promoting that economy that we've been describing. And I'll say one thing real quick. I'm sorry I'm long-winded with the answer. This is not something to be thought of in a charitable sense. We're not talking about subsidizing the consumption habits of people per se as it relates to things that aren't essential, but rather providing people with the tools and resources, not only so that they can have livelihood, but so that they can contribute in a dynamic way to our economy. I think a dollar invested in people will lead to a bigger bang, a greater dynamism than a dollar vested elsewhere in the ways in which we invest.
Thank you so much, Professor Hamilton. I want to yield to Chair Sanders. I did ask my fair share of questions, and I want to be invited back.
Well, by virtue of your interest in the subject, you will be invited back many times. Professor Hamilton, I first wish that I had your mathematical ability. When I leave here, I am going to a class in statistics, which is these are times that try men's souls, and I'm going to pray that the good Lord take a little from you and give to me when I'm in that class, since it's not coming up. However, having said that, it's an interesting how you pointed out what I pointed out to my friend William, who was here earlier, and the common perception that if the poor just knew how to manage their money better, they would stop being poor or be less poor, or better yet, they would make better choices. It's a common perception, but it's not the reality of the ground. Again, as you pointed out, if you have no choices, or if you only have one choice, that's not a choice. Um, Now, my friend John just put up he spoke of the need for coming up with putting money into minority banks. How's that idea, and how useful is that idea to deal with the questions of the day, sir?
There is a inconvenient truth that I'm going to say, and it might not be so popular. Banking black, and we can expand it to buying black, is not going to be an ultimate solution to these problems. That said, I value minority banks. I value investments in these banks, uh, because we should have access to banking, and black people should have access to being able to build banks just like any other people. But the reality of this is being able to redress our larger structural problems is grounded in simple arithmetic, if you ask me. They just don't have the capital to be able to accommodate the entire uh, group of people, as well as all the problems that exist right now. So when some of the previous witnesses testified to a value of trying to have some of these minority institutes service the needs that uh, the traditional commercial banks or the white commercial banks aren't serving, I think that is deflecting in a way that might not be the most productive from direct provisions from the public sector. So I hope I'm being clear in saying that there's certainly value in black banks, but if we think that that is going to be the panacea, or the biggest impetus to address these existing problems, I think we'll be mistaken.
Well, I had the pleasure of getting to know Mr. Witowski a little bit more, and I would dare say that he doesn't believe, or he in this position does not believe it's the total picture. It would not be the total understanding. I'll go out on that limb and say that based on my knowledge of him. But he would dare say that it would be an important component, something that we can do now, something that would be doable while instead of waiting for the larger picture to get together. Incidentally, on this very issue, my Republican colleague has spoken to me already and said that he is interested in writing this bill with me to see what we can do about this. This may be a politically feasible thing to do under these conditions, sir. With that knowledge, and I agree with you, it's not, this is not the silver bullet either. This is not the one thing or the one or two things that would change everything. But could it be a useful development to create some justice in the banking system?
Thank you, Senator. And I'd say, yeah, my answer was largely about scale. But but that said, here's some things we do know. We do know that black banks are more likely to operate in black communities, are more likely to promote community development in black communities, and literally hire black people. So all those things, and there is aesthetic value in being able to see oneself in certain prominent positions. So with the caveat of concerns around scale, investments in Black banks without certainly has value that I think would be a productive endeavor from uh, the New York Assembly.
Okay, I thank you for that. We are coming to the end of this hearing, sir. Is there any final word, any final thought that you want to share with us as we are taking the state of New York, a budget of $293 billion, larger than many countries of this on this planet? How can we use this in terms of its banking to create the beloved community, the just New York that I believe the overwhelming amount of New Yorkers want to see? How do we use it, sir?
I think we just need a new conception of industrial policy. First thing is that it is a misnomer that the state is not it's a misnomer to think that there are periods in which the state doesn't engage in industrial policy. A tax cut is industrial policy. Uh, Governments are always engaged in industrial policy. So the question is how they do it. And I think a refocus on doing industrial policy that invests in people and the environments in which they live in a affirmatively inclusive way. So there's a recognition that we have a long history of devaluing certain people for various reasons. So if we want to change that history, we're going to have intentionality. We're going to have to design, manage, and implement policies with intentional or affirmative inclusion. But we need these investments in people with the conception that this is not simple charity. These are activities that promote flourishing and a dynamism that not only benefit people in their communities, but also benefit firms. But it does so in a way that's more just, more egalitarian, and does what I believe your purpose is, which is to promote human flourishing. So, with that fiduciary in mind, I think that reorientation, and if this sounds esoteric, I have plenty of policies that we can implement that can bring this to reality.
I look forward to your sharing those policies with us because this committee is an activist committee in the sense that we are not just going to bemoan the facts. We are going to try to change the facts. We are going to try to create the just New York where equality of opportunity is true for everyone. Where Langston Hughes said it best. He said he wanted America to be America for everyone, for him too. And we want New York to be New York for everyone. And with that, I'm going to remind people that we do fair hearings here. We allow all sides to speak. We allow a multitude of positions and ideologies, all kinds of people who have a right to speak, because I believe that all of us are trying to get to a better place. And the idea may come from a position that we haven't heard before, or one that we usually disagree with. But in this type of committee and this type of hearing, we're going to do this. I, of course, want to thank my leader, Andrea Stewart-Cousins, the leader of the state Senate, the New York State Senate, for allowing not only this hearing, but my opportunity to be the chair of banking. My being here is a sign that she wants to see change. She wants responsible change. She wants well thought out change. She wants a goal that we're trying to get to that's better than where we are, but she is willing to go for change, and so are the majority of the members here. So by saying that, sir, I'm saying we welcome you more ways than one, and encourage you. One thing that I have discovered that governing can be fun. Coming up with stuff can be fun. It's good to think a problem through, as we should. But imagine having the ability to implement some policy to remedy the situation, to perhaps repair a situation. That is an incredible fun that I encourage all of you academians, and I use it in the best sense of the word. I aspire myself, mind you, all academians to have a very practical knowledge too, to get out and realize that we, the elected, have to make it work for all the people. That the danger and the fun and the opportunity that we have, may the good Lord offer you that opportunity, and you seize it and do worthy things with it. Now, having said that, sir, I again want to thank you for participating in this hearing, and to all of those intrepid souls who were able to stay from the beginning to the end. Bless your hearts. Thank you for being here. I encourage you, you have a role too. If you see something that we could have done better, or some points that were not taken, please submit them to my office. Sometimes the truth is not necessarily in this panel or in this panel, but the truth may be sitting right up there in the audience. You may have a piece of the puzzle that we just can't see. And I encourage real people to, not that we are not real, but I got to find a better word, Dr. Hamilton. I encourage, I don't know what, other worthy people to come up with things. And to my friends who provided the technical assistance, I thank you. To those who were kind enough to try to keep me out of trouble down here, I thank y'all. You have a hard job with that. It's keeping me out of trouble as a 24/7 job, and a lot of overtime at that. But I thank you for that. I also thank Paul, and to all of the rest of my staff that prepared me well for this hearing. Having said that, I shall say this hearing is over. Thank you very much. By the powers invested in me, it is done.